to all our viewers on Moneycontrol. I'm Karunya Rao, and today we'll do a deep dive analysis on what makes IndusInd Bank the perfect candidate to ride the post-COVID recovery. The onset of COVID last year was a difficult phase for IndusInd Bank with burgeoning bad asset problems and a run on deposits following the Yes Bank fiasco. However, in the past 1 year, it has embarked upon a cleanup drive resulting in recognition of stress, cleaning up of the troubled corporate book, adequate provision cover, build-up of a granular retail-oriented deposit book, diversifying and granularizing asset book, and finally adequate capital buffer to drive growth and win market share. NII was aided by stable interest margin on the back of improvement in lending yield and a decline in cost of funds despite the drag from excess liquidity on the balance sheet. The cost-to-income ratio for IndusInd Bank was also stable. This is despite an uptick in the business momentum. Asset quality also held up well, recognizing all the remaining COVID pain. They reported a GNPA of 2.67% and a net NPA of 0.69%, representing a decline from the previous quarter. It is comforting to see the bank have an actual provision coverage of 75%. What is reassuring about the bank's strategy is that it has conservatively provided 100% against unsecured retail and MFI loans. Of the actual Q4 slippage of 3,829 crores, around 1,899 crore of corporate slippage was technical in nature, and the remaining slippage of 1,930 crore was lower than the pro forma slippage of Q3. The amount of restructuring at 2.01% of advances prima facie looks higher than most peers, and a large part is driven by vehicle loan borrowers who want to preserve cash amid the economic uncertainty. The bank carries excess buffer provision of 1,600 crores that provides some cushion to face uncertain times over the near term. And given the dominance of vehicle finance and microfinance on the loan book, short-term increase in slippage cannot be ruled out. We have factored in an elevated slippage in our estimates for FY22, but given the health of the balance sheet, that should not worry investors. In line with the bank's approach to improve underwriting standards and bring more granularity to assets, loan book growth has been tepid so far. YOY, there's been a growth of 2.8%, sequentially 2.6% uptick in Q4. The bank has been degrowing its large corporate book to get its quality right. Outside large corporates, the growth drivers have essentially been vehicle finance, small and mid corporates, as well as microfinance. Overall, its corporate book with a share of 43% has degrown, and the growth has now started to come essentially from retail with a share of 57%. That the bank is onboarding better quality of assets is also reflected in the decline in the ratio of risk-weighted assets to total assets at 75% from 84% in the previous quarter. Thanks to the warrant conversion by promoters, the capital adequacy ratio got a further boost. IndusInd Bank's comfortable capital adequacy ratio of 17.38% prepares the ground for a strong growth post-COVID. The bank is optimistic in areas where it has domain expertise like vehicle finance, gems and jewelry, and microfinance. Incidentally, compared to competition, its MFI book has shown tremendous resilience so far. IndusInd has seen a strong surge in deposits, 27% year-on-year and 7% sequentially. Consequently, the credit to deposit ratio has fallen to 83% from 102% in the year-ago period. Its CASA growth at 31% YOY resulted in CASA share improving to 41.7%. Bank has been steadily dropping rates on deposits without seeing any reversal inflows and has managed to see 102 basis points reduction in the cost of deposits in the past year and 31 basis points in the last quarter. Steady decline in cost of funds coupled with high-yielding retail books spells good news for interest margin, and as the excess liquidity wanes in the return of growth, this should play out. IndusInd Bank seems much better prepared to face the challenges of the second wave of the pandemic, armed with capital, excess provision and a high-quality balance sheet. Near-term focus is on collection, broad-basing the growth and improving the deposit franchise. While growth might take a backseat amid challenging near-term macros, we see it coming back in the second half onwards. Of course, there are some key risks. Second wave of COVID impacting earnings as well as asset quality is a big risk to watch out for. But with an undemanding valuation of 1.3x price to book of FY23, we see immense headroom for re-rating given the much improved earnings quality and the right ingredients of growth in place.